Okay, I guess we're on. So good morning, everybody. We've got the coziest crowd yet this morning. See, this is what happens. I was just talking to one of your classmates a minute ago. This is what happens when you give a curve. See, because now everybody says, oh, good, I'm good to go now. And then they stop coming to class. And then what will happen, mark my words, what will happen is on the next exam, they won't do very well. And then they'll all start coming back to class again. That happens every semester, so nothing new. All right, so I finally had a chance to look at all of the grades and everything. I have the grades uploaded, so Canvas should be up to date on grades. If you don't hear anything else I say this morning, wake up right now and hear this. Go on Canvas and double check your grades. Okay, everything should be right on there. Okay, everything should be okay. But go on there and double check your grades to make sure that they're correct. Now understand that Canvas, and this is a flaw in Canvas with the homework, and we're going to fix this. We're going to bring this up to date right around the next exam. But in Canvas, if you didn't do a homework, then it doesn't even count it at all. So it doesn't count it in your points available. So there can be a little bit of a difference between your grade on Canvas and what your real grade is, okay? But really what I'm getting at more importantly than that is double check your homework grades on Canvas. On Canvas, and make sure that they are correct. And they should be correct. But with 1,000 people, things happen. For example, there are 2 people in this class that have the exact same name. Okay, so I think we've got, we've got to match it up by IDs. So I think we got it right. Double check. Sometimes on Canvas, their name will be Chris. On Connect, their name will be Christopher. Okay, I think we got it correct. Double check. All right, so make sure you do that. Do it today. I was going to say this week. Do it today. Don't wait until December and then say, oh, the homework, the first 5 homework problems aren't right, because it's going to be a headache, and it'll be a headache for us to untangle. It'll also be a headache for you because it might bleed beyond the semester, and you don't want to do that, okay? So just double check your homework to make sure everything's okay. Like I say, everything should be all right on there, but with 1,011 students, things happen. Okay, so double check that. I posted all the exam info. The exams look pretty good. There was only one question missed by more than half the class on there, and it was a good question. Actually, there were a couple of other questions that technically were, but they were missed by like 49.2% of the class. All right, and with 1,000 students, that's close enough for me. So really, there was only one question on there. We also went through and the TAs went through and fixed that one question that I actually intended to fix before the exam that didn't get fixed, but they went through and did that. That did not apply to everybody. There was, I think, 309 people, only 309 that had that particular question. So only those grades, and even some of those weren't affected because they might have just answered it right in the first place. So it probably only applied to about 10% of the class. Okay, but got that all straightened out. So what I did was I went ahead after the first exam. Just for the record, I did not promise you that I was going to give you a curve. I heard a lot of rumbling about that and all that kind of stuff. And just for the record, go back and look at my announcements. All right, and I said it in class. I did not promise you a curve. What I promised you was that I would go back and revisit the decision. Okay, so just for the record, students tend to hear what they want to hear. Just for the record, that's what I said. But anyhow, between the 2 exams, what I did was I put in a 4 question curve for both first and second exam. You can allocate those 4 questions however makes you the happiest. So I just did that just to help out the grades and just to help everything out. And so after doing that, the average in the class is a 77%. Which is pretty darn good. Okay, so and that's about what I would expect at this point in the course. So the average was 77%, and about 77% of the class has at least a C in the class, it's actually better than that because there are a whole group down at the bottom where they took one of the exams but not the other. So I'm not sure if they have withdrawn from the class, because sometimes what they'll do is they'll quit coming to class, so in their head they withdrawn from class, but they haven't technically withdrawn, so they're still on the rolls. So there's some of that down there. So it's actually a little better. It's actually a little better than that, because that stuff is dragging down the average. And also, like I say, some have. I mean, they've checked out. So they shouldn't count, but they're probably still down in there. So it's actually a little better than what it appears. So okay. So anyhow, so that's all good. The TAs will be available if you want to go see your exam. They'll walk you through it, take a look at what you missed, explain it, so forth and so on. Before I forget, I'm having my monthly meeting with the TAs. So we'll be meeting between about 11 and 1 today. So if you want to get with them, either get up there before or 11, or just go have a nice relaxing lunch and then come back around 1 o'clock or so, and they should be back somewhere in that general area. Okay, and then they'll be here till 4 o'clock today. Okay. Let's see, and I think that's it. I've had a few, see, this is what I get for saying this last time. I've had a few emails from other sources. If you're going to contact us, make sure you email us through ACG 3173, please, so we can keep track of all of our emails. And I think that's it. Questions? Questions? Gremlin's up here this morning. Question? Oh, yeah. Oh, thank you. I'm going to set the homework this afternoon. Yeah, I was going to do it before class, and I think I need to change my office hours. I mean, I like seeing you all, but I need the time before class to actually get ready for class, and I end up talking too much and not getting ready for class. So I meant to do it before. Thank you for reminding me of that. Yeah, I'll set the homework this afternoon for chapter, because we shouldn't have any problem finishing up chapter 8 today. Okay. Other question? Yeah, because I want to look at it. I want to go back through the questions and double check. So I should have that set this afternoon. If not this afternoon, definitely tomorrow. But you'll have at least a week to do it. So no worries. Yeah. Yeah, I'll have one more exam and then the final. Yeah. Okay. Other questions? That's good though, because the more exams you have, the more opportunity you have to get good grades. Oh. Okay. Other questions? Other questions? Go on. Okay. All right, then let's go ahead and continue on. I thought there was something on here I wanted to draw your attention to. McDonald's, motorcycles, all the important things. Don't remember what it was. Okay, so in Chapter 8, we're talking about one of the most important topics of this semester, in my opinion. That's the equity section of the financial statements, because most people don't, most people don't understand the equity section. So we went through last time in pretty good detail the common accounts that are in there: preferred stock, common stock, additional paid-in capital, retained earnings, treasury stock. We're going to talk a little bit more about treasury stock here in a minute. So all of that should be pretty familiar to you at this point. One of the things where we left off yesterday, we were talking about dividends. Exam question: dividends are paid from where? Very good. Retained earnings. Okay. Now, most commonly, they are paid in cash. Okay. But dividends are a distribution of profits to the owners. Okay, therefore they are paid from retained earnings. Retained earnings are profits. Okay, but the form of the dividend can take three forms. Cash, of course, we talked about that a little bit yesterday. But they can also pay dividend in stock. I think we. No, I just hit this. I think we talked about that briefly yesterday. We're going to talk about that a little bit more in a minute. But also, dividends can be paid in property. I know we talked about this because I was talking about distributing the computer last time. Okay, if dividends are paid in stock or paid in property, they're called payments in kind. Payments in kind. Okay, and this is mostly a small business issue right here. I mean, you're not going to see Apple pay dividends in property. I wish they would, because I'm an Apple owner. So if they wanted to pay me a new iPhone as a dividend, that would work for me. But I'm not going to hold my breath for that. Okay, so this is mostly a small business issue right there. Okay, so. The slides in here, this one in particular, is pretty darn descriptive. So this is a good slide. They're talking about cash dividends. Really, all dividends must be declared by the board of directors. We talked about that yesterday. Somebody had asked a question about a CFO paying a dividend. Okay, the dividend has to be approved by the board of directors. All right. So, and it implies here that only cash dividends have to do that, but all dividends need to be declared by the board of directors. If they're paying a cash dividend, then of course they have to have sufficient cash. But if they're paying a stock dividend or a dividend in property, then they don't, because it's irrelevant. All right. In fact, one of the reasons to pay a stock dividend is to save on cash. Okay, or if they don't have the cash to pay a cash dividend, they pay a stock dividend. So that's actually one of the reasons to do that. So this slide is very good and very descriptive. Just understand that they are talking about cash dividends right here. In fact, you can look at it this way: cash dividends. All right. Okay, and this box here is really important as well. You guys all told me on Tuesday that you knew that corporations aren't required to pay dividends, but so there is no obligation to pay dividends, okay? But once the board of directors declares a dividend, then at that point, it does become an obligation. Okay? So once they declare a dividend, then it is an obligation to the company, and it is recorded as such, and we'll see that in just one second here. Yeah?
When they declare it, is it only for that period, or is it for all future periods?
No, it's just, they'll declare a one-time dividend. Okay, so for example, right here in January, board of directors is coming to declared cash dividend, blah 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 blah. So the dividend is payable to stockholders on record at February 5th, and it's paid on March 5th. Okay, so this is I've never seen a dividend that didn't work like this. Okay, so it's just this one-time dividend. Usually, with the big publicly traded companies. Actually, usually may not be the right word there, but with the plain vanilla type dividend for the big companies is they pay quarterly dividends. So what will happen is they'll get together every quarter, the board of directors will decide on the dividend and declare a dividend. And when they do that, so before they do that, no obligation, they don't have to pay a dividend. But once they do declare a dividend, then this is the entry that's made right here. Yeah?
Do you have to specify the type of dividend?
Yes. They got to specify the type of dividend, the amount of the dividend, when it's payable, date of record, all that stuff.
What if the company, after they declare it, goes through some kind of financial distress and they're able to meet the obligation?
If they go through financial distress after they declare a dividend, they got a problem. Because once they declare the dividend, then notice what happens at that point in time is the dividend is taken out of retained earnings and put into the liability account. Okay? So it is an obligation at that point in time. Now, as a practical matter, probably nothing's going to happen because we're talking about, a month. So probably nothing's going to happen. Plus, like I say, most of the time, dividends are paid in cash. So before they declare the dividend, they have the cash in the first place. So as a practical matter, nothing is going to happen. But if it did, then it's a liability, just like the other liabilities. Okay. All right. So here, good exam question here is, what's the effect on the debt ratio? Just as an example, as a result of declaring the dividend. Okay. Well, what is the debt ratio? Every exam review, but in particular final exam, but what's the debt ratio? Total debt over assets. Total debt over assets. Whoops. Okay. So, as a result of this, what happens to debt? It goes up. As a result of this, what happens to assets? What kind of account is dividends payable? That's a liability, so that's why our debt's going up. What kind of account is retained earnings? That's an equity account. So is that affecting assets? No. So there's no effect. Therefore, the debt ratio would go up. Now, if you wanted to, similar ratio, the debt to equity ratio. Well, what's happening there? Debt's still going up. We're on top of that. But now, equity is going down. So that ratio will also go up. Both of those ratios are indicators of leverage. They're indicators of risk. Okay? So, I mean, it's not going to go up very much, but it will go up nonetheless. Okay? All right, so that's what happens when the dividend is declared. Questions about that? Yeah?
Sorry, so there's no net effect on the actual debt-to-equity ratio through this? No.
No, there is. That's what we just said. It's going to go up. Yeah. No, because equity's going down. Equity's going down, which is covered up by my cursor. Okay. Other questions? Okay, so that's when the dividend is declared. It's moved out of profits and into liability. Date of record, there's nothing that happens there. Okay, that's just the date that everybody's, whoever owns the stock at that time, that's who gets the dividend. And then, when the dividend's actually paid, what would happen to the debt-to-equity ratio? Just thinking off the top of my head. When the dividend's actually paid, liabilities would go down. That's correct. You got to pay out dividends through retained earnings. Would equity decrease? Right. Which is why liabilities are going down, but the equity was affected, back here. So when the dividend's actually paid, then the liability is decreasing because they no longer owe the dividend, but they're paying it in, and we should have specified cash even though it was on there, but if they're paying it in cash, then an asset is going down. An asset is going down. Therefore, the effect on equity would be 0. Okay. So the debt-to-equity ratio would go down. Okay? All right, so those are cash dividends. Probably the most common type right there are cash dividends. Okay? And by the way, they have stock dividends. They don't have property dividends on here, which is fine. Property dividend would work the same way as the cash dividend. The problem, and small businesses get themselves in trouble this way, the problem with payments in kind, the property dividends, is quantifying the amount of the dividend. Okay? Because the example I gave you on Tuesday, I think there were 4 of us that were in a company. One person got a computer, so we're calling it a dividend, which is all well and good, and you can actually do that, but first of all, everybody else has to get their pro rata share of the dividend. Okay? That's very important. They got to get their pro rata share of the dividend, which just means their proportion of the dividend. Okay? So if all 4 of us are equal shareholders, then we have a right to equal dividends. Okay? If Kelsey has 100 shares and he has 200 shares, then he's entitled to twice as much as her. Okay, so that's all that pro rata means, is just your proportion. But the problem with property dividends is, well, that computer that we distributed to her, what's it worth? So assigning the fair market value to it is the problem, because whatever that's assigned, then we are entitled to our pro rata share of that as well. Okay? And that's where small businesses get themselves into binds often. Yeah.
Based upon this, then why would you want to even declare a dividend if it could arise from this problem for a small business?
Well, what I'm talking about is property dividends. And the reason like I said last time, the reason they do that, is that me? The reason they do that is to avoid payroll taxes. I mean, that's really, for small businesses, in my experience, usually the reason they're doing that is to avoid payroll taxes, which is why they get themselves in trouble, okay? Because think about it, final exam review, all 4 of us are in the corporation, assuming we're actually employees of the corporation also. So we're working in the corporation, okay? The corporation is going to give us money, all right? That money is either going to be wages or dividends. Well, whatever work we're performing for the company, we're entitled to fair wages for that. Okay? Well, and in extreme cases, what will sometimes happen is they'll form a corporation. They don't want to pay the payroll taxes, so they take 0 wages and then try and start taking out all these dividends. That's my point. It is illegal. That's my point. And then what will happen is the IRS will come in and reclassify that, what was dividends, as wages. Okay, so those, and it turns into a big mess. So the bottom line of that is there is nothing wrong with distributing property as a dividend. That's perfectly legitimate. There's no problem with that. You just got to be careful and you got to do it right. That's all. That's all. Okay. So, all right. So with that, another alternative here is stock dividends. So they can, they might pay out, I don't know, a 3% stock dividend or something, which it just means that if you're a shareholder and they pay a 3% stock dividend, that means that your number of shares is going to go up by 3%. Okay, so this is just actually distributing more shares to you. Probably the disadvantage of this is that the share price, not the par value, okay, the share price is going to go down. Okay, that's supply and, well, maybe not supply and demand, but it's supply because there are now more shares on the market. Right? So if the company is worth, and the company's worth in total the same amount, okay, but if you put more shares on the market, then each share is going to be worth less, but you're going to have more shares. Okay, so overall, nothing will change. It's like a pizza. Okay, the size of the pizza isn't going to change. It's just a question of how small we're going to make the slices. That's all. Okay, this is actually an attractive way to pay dividends because number one, you don't have to worry about cash. Okay, also there are tax advantages to the shareholders of paying stock dividends because, similar to what I said on Tuesday, I'm the corporation, you guys are all shareholders. If I pay you a cash dividend, you're taxed on that this year, whether you like it or not. And you may not like it. Okay? If I pay you a stock dividend, then you're not taxed on that, unless you choose to sell the shares. So the decision is yours. And even if you do, then we're back into the capital gain conversation that we had on Tuesday. Okay. Real world note here. I'm not going to get this tricky with you on the exam, but real world note. If you're paid, so you get a cash dividend, you're taxed on that. The reason is because you actually get the cash, so you have the ability to pay the tax. If I pay you a stock dividend, you're not taxed on that. Reason is because you actually didn't get the cash in order to pay the tax. Okay? But if you have the option of getting either a stock or a cash dividend, which sometimes happens, okay? If you have that option, then if you choose the stock dividend, you'll still be taxed on it because you had the option of getting the cash, all right? I'm not going to get that tricky with you on the exam, but just a kind of interesting real-world note, okay? So that's a rule that not very many people are aware of, okay? All right, so again, another pretty good descriptive slide here. So you know I'm not in the habit of reading PowerPoint slides to you, but when we get good ones, I do want to make sure we point out everything on there. So okay, so again, the par value and the total equity isn't going to change, but the market value of the individual shares will change. They'll go down. Okay, so again, it's just taking the pizza, the size of the pizza isn't going to change, just a matter of how many slices we're going to have in it. Okay, the shareholders, this is called a preemptive right. As a result of the stock dividend, the shareholders' percentage ownership in the company can't change. Because if it could, if you think about it, that would be a way to shift power in the corporation. And that's illegal. That's a no-no. All right, so the percentage ownership won't change, even though the number of shares will go up. Preserved cash, we talked about that, decrease the stock price, and of course this will also come out of retained earnings. So you'll have the same same type of entry. Okay. All right, so those are the three forms of dividends, but just make sure you understand all of them are a result of retained earnings. So when you hear things like, where are dividends coming from, they're coming out of retained earnings, right? Because if you don't have retained earnings, we had this conversation last time. If you don't have retained earnings, you can't pay dividends. Okay? All right, so something else that can happen with stocks is what's called a stock split. And stock splits are actually pretty easy, okay? The most common type of stock split is a 2-for-1 stock split, okay? So again, I'm the company, you guys are all shareholders. If I declare a 2-for-1 stock split, all that means is that the price of your stock is going to be cut in half, but you're going to have twice as many shares. Okay? So again, overall, nothing is changing as a result of the mechanics of the stock split. Okay? But the most common reason to do this is to reduce the share price. In fact, not too long ago, I guess it was about 2 years ago now, Apple split their stock because Apple stock was trading up at $600 and some odd a share, and they split it. I think it was like 7-to-1. Split at 7-1 to bring the share price down into the $100 range. Okay, yeah, it was like about 2 years ago. I should have looked that up. Yes.
Another one was, I know that split actually recently was MasterCard.
MasterCard split. Okay, yeah, I'm not familiar with that, but I take your word for it.
I think that companies like Amazon and Chipotle will actually split since they're up so high.
I have no idea whether or not Chipotle or any of the others will actually split or not. What I do know is the common reason for doing this is to lower the share price. But you see, the thing is, that used to mean more than it does now. Okay? Back in the 70s, when trading was different, having a lower share price was important because it meant more people could afford the shares. Okay? Plus, back then, shares were usually traded in 100-share lots. Okay, but now with computers and everything, and with all the hedge fund, or not hedge funds, but all the institutional investors we have and all that kind of stuff, it doesn't really mean as much as it used to, at least not in my view. And then there are the hard heads out there like Warren Buffett, who refuses to split his stock. And I don't know where we're at now, but last time I looked, the value of Berkshire Hathaway was trading at something like $80,000 per share, and he likes that. If for no other reason than it screws up the columns in the Wall Street Journal, because with all the stock quotes in the Wall Street Journal, there's like 2 or 3 3 columns because most everybody's whose stock is more than $1,000 a share, except for Warren Buffett's. He's got like $80,000 a share. So. Oh, did it? Okay. Yeah. Well, and there's actually there's 2 classes of Berkshire Hathaway stock. I believe the original class didn't, but anyhow, my funny point is that there are exceptions out there, and his stock was at like $80,000 a share, or something like that. So anyhow, all right. Okay, stock splits are very easy. Very easy. Okay, the example they have here, this 300,000 shares, $1 share, 2-for-1 stock split. Okay, so what happens is as follows. Again, it's kind of a similar conversation. The size of the pizza isn't changing. All we're doing is changing the number of slices. Okay, and the trick to this is that you have to have the same amount after the stock split as before the stock split. Okay. So that's the trick to this. So what happens is as follows. They're having a 2-for-1 stock split. So before the stock split, their equity had 300,000 common shares. Okay. The par value per share is $1. The same thing would apply to the market price. Okay. So par value $1. If the market price was $20, okay, the same thing would happen because the market price is going to drop. Okay. So before the split, they have par value of 300,000. Okay. Again, the trick is that after the split, they have to have the same par value. So for a 2-for-1 stock split, what that means is if you guys are shareholders, for every 1 share you had before the split, you now have 2 shares. Okay? So your number of shares doubled, but the price is going to drop in half. So overall, you still have the same, your portfolio value will still be the same. Okay? So, number of shares, and the way, there's nothing wrong with the way that they do it here. I set it up slightly differently. Okay? And the way I do it is as follows. The number of shares in a 2-for-1 stock split, multiply that by 2, that's supposed to be 2 over 1. Okay. Multiply that by 2 over 1, that gives you your 600,000 shares. The par value or the market value, whichever one you're dealing with that with, multiply that by 1/2, by the inverse. And that's it. Okay. So the concept is simple. All right, and this is a simple example, but sometimes the splits get ugly. Like I just said, Apple, I think theirs was like 7-for-1, something like that, 6-for-1, something like that. Sometimes you'll see crazy splits like a 5-for-4 stock split, you know, or a 7-for-3 stock split, all this kind of stuff. So I could give you a crazy stock split on the exam, no issue. If I said this company split 5-for-4, how would you handle it? Number of shares times 5/4. Value per share times. There you go. Yeah. What the company gets out of doing this is it lowers what they're trying to get out of it. Okay. As a result of the mechanics of this, the stock price will drop. Okay, so the overall value won't change, but what they're hoping to do is to attract more investors because the stock is now more affordable, so presumably more people can afford it. Therefore, that creates demand, which brings prices up. That's what they're trying to, and that's also what I was saying a minute ago, is that it used to be more important than it is now. I mean, your retirement fund at work, which is, you know, presumably managing $200 million. Do they really care whether Apple stock is trading at $100 a share or $600 a share? Probably not. Probably not. Okay, so I think it would be fair to say that it used to mean more than it does now. Yep.
What is the impact on the individual investor of the stock company?
Same thing. It's the same thing. It's on the individual investor as a result of the mechanics. Nothing's going to change, but if the share price goes up for the company, it's also going up for the individuals. Yeah, yeah. Which actually is another advantage because if you had 100 shares before the split, the least amount you could sell would be 1 share, which would be what, 1%. But if it's a 6-for-1 and now you have 600 shares, then you could still just sell 1 share, which would be a smaller percentage. So you might be more apt to sell it if you wanted to do that. Okay? Yeah.
So is it in the stockholder interest for them to split it?
Is it in the stockholders' interest for them to split it? Yeah. Yeah, I would say so because really, at the end of the day, what they're trying to do is increase their stock value. I mean, so that's good for both the company and for the owners of the stock. So, yeah. Yeah.
Is there a reverse to it? Like it's on a split?
Yeah, they can have reverse stock splits. So instead of a 2-for-1 stock split, they might have a reverse 1-for-2 stock split, which would be, and that's a good question, because that would be trying to accomplish the opposite. Suppose you've got a company where the stock has really tanked, all right, and now the stock price is down at $1.20 per share. Okay. Well, there are issues with investors buying stocks that low, not to mention it makes the company look bad. So they may actually do a reverse, it's called a reverse stock split, in order to raise the share price as a result of the stock split. Okay. If I wanted to get ugly, I could do that on here, no issue. No issue. 1-for-2 reverse stock split. What is it? Multiply by 1, 2, multiply by 2. So, yeah. No, they're not repurchasing it. It's a reverse stock split. So they're just taking shares off the market. So again, in a 1-for-2, for every 2 shares you had before it, now you only have 1. But it's twice as valuable.
Repurchasing is just another strategy of just trying to increase the stock price?
I'm sorry, what's just another strategy? Yeah.
Treasury stock.
Yeah.
Repurchasing. So
Yeah.
that's another strategy to try to raise the stock price.
Repurchasing stock?
Yeah.
Yes. Yeah. Yeah. In fact, I think did we talk about repurchasing already? Yeah. I think we got another slide coming up on it, so we'll be talking about it here in a minute. But yeah, it's just really kind of at the end of the day, and you talk about this over in 3403. Really, in the end, every decision that a corporation makes has the ultimate goal of raising the stock price. I mean, that's really why they're doing everything that they do. That's what they're supposed to be doing. Let me put it like that. So, okay. All right, where are we at? Stock splits. So we got all that. Okay. We've talked about the most common equity accounts. There's one other, and I think we talked about this earlier, but probably not in great detail. But even if we did, we're going to do it again. I'm going to use my highlighter. That's sweet. Okay. If you look on, and this changed in 1997. Okay, the reporting of this, the way that companies did it didn't really change, but they all reported it differently. So kind of in 1997, they put out a pronouncement so everybody was reporting it in a comparable way, which final exam review be reminded, that's the purpose of GAAP. One of the purposes of GAAP is so that financial statements are comparable. All right? If I'm an investor and you guys all are CFOs of different corporations and you're all reporting things differently and I'm trying to decide who to invest in, if it's not easily comparable, I'm less likely to invest. If I'm less likely to invest, an exchange doesn't take place and the economy suffers. Okay, so final exam review there. All right, so this is off Walmart. Okay, so real life here. So their equity sector, we got common stock. Notice they have capital in excess of par value, which is just another way of saying outstanding. Additional paid in capital, retained earnings, and they have this other comprehensive income account here. We talked about this before, didn't we? What is other comprehensive income? What does this represent? Yeah, outside their normal business. Tricky way to say it. He said outside their normal business activities. That's a tricky way to say it. Yeah. Income from non-operating activities. Another tricky way to say it, okay? Other comprehensive income represents income that is not reported on the income statement, okay? So this, and you see this on a lot of, in fact, you see it on every set of financial statements. And it's actually very interesting, and it's very important for us as decision makers. In fact, now that I said that, I know we talked about it before because I remember saying all this stuff before, but it's very important for us as decision makers because not a lot of people understand it. They don't really understand what's going on. This is income that is not on the income statement. Therefore, it's not in earnings per share. And companies live and die by their earnings per share. In fact, there was just something yesterday. Apple was releasing their earnings. They were expecting price to tank. You just saw at the beginning of class today, I mentioned McDonald's. I haven't looked at it, but apparently their share price went up because they just how much did it go up?
Oh, I don't know how much, but I know they started doing all-day breakfast.
Yeah, they started doing. Yeah, we don't know about the share price, but we're on top of all-day breakfast, and I am too. So we got that one. We're on top of that. But no, they just released their earnings per share, so apparently their stock price has jumped as a result of that. But that doesn't include other income. Not all items of income are included in there. Okay. So again, McDonald's, their earnings beat, which is all well and good, but what's going on over in this other income that's not even reported in that? Because if there's, let's say, a loss over there, then maybe this upside reaction is not warranted. Okay, so here's the problem. And this is what kind of led to this. What we want as decision makers in terms of the information from the company, okay? What we want is information that's both relevant and reliable. Okay? We want information that's both relevant and reliable. Which, if you think about it for 30 seconds, that's obvious. Okay, if we get information and they have a $5 account receivable that's actually not an account receivable, who cares? Okay, that's not relevant. Okay. Or we get all this information, like I told you before, about the, remember my story about the Russian stock market. Okay. Well, the reason we didn't do that is we could get the information, but it wasn't reliable. Okay. So what we want is information that's relevant and reliable. And a major variable in that is the timing of the information. Okay? So relevant information, I think this would be a fair statement. Relevant information, or let me put this another way. Information is probably the most relevant when it occurs. Okay? So timeliness, this is an issue of timeliness. It's probably the most relevant when it occurs. But it's the most reliable when it's realized, which is to say when we actually get something for it. Okay. So we can look at things when they occur, but if we haven't received anything yet, then how do we know how to measure it? How do we know whether or not the measurement is reliable? Okay. On the other hand, when we do get something, then we do know how to measure it. Okay. But it may be late. It may be a year down the road, and therefore it's not really relevant anymore. And this is the issue that the standard makers struggled with in terms of reporting these particular items. And by the way, OCI only applies to particular items on the balance sheet, which we'll get to in just a second, or particular items in the company, which is why I was kind of hedging on non-operating sources and all that kind of stuff, because hedging is part of it. That's a tricky way to say it. Okay, so. The gist of, not the gist of it, what's going on here is as follows. What they've decided to do is that on the balance sheet, things are recorded, and again, we're talking about specific items. We'll go through those in just a second. They're recorded on the balance sheet when they occur. But they're not recorded on the income statement until they're realized. So kind of in between the two of this is what creates the need for other comprehensive income. Okay. For example, let's say that your company, or a company, owns marketable securities that are available for sale. Final exam review, remember, available for sale as opposed to held to maturity. Okay. If they're held to maturity, they're going to be carried on the balance sheet at cost. Okay. But let's say that your company has marketable securities that are held available for sale, so they're held at fair market value on the balance sheet. Okay. Let's say during the course of the year that the marketable securities have gone up $50,000 in value. Okay? All right. So at the end of the year, the way this will be presented on the financial statements is, again, on the balance sheet, so the marketable security account on the balance sheet, it's going to be recorded when it occurs. Okay. So marketable securities will be written up by $50,000. But it's not going to be recorded on the income statement It's not going to be recorded on the income statement until it's actually realized. They haven't realized anything for this because they still own the securities. Now, if they had sold the securities, then it would hit the income statement, and that would be gain or loss, and you go through all of that, and that would all be part of earnings per share. But they still own it, therefore they haven't realized anything yet. Okay? So there's a need for another account, and that account, as you have presumably guessed by now, would be other comprehensive income. All right, so far so good? All right, let me see where we're at. Got that. Hang on. I got way ahead of my notes here. Stock split. I want to make sure I get everything on this. This is a very important topic. So we got so reliable. We got all that. Okay. All right. So these are the most common items. There may be some others that are included in other comprehensive income that I'm not sure about, but these are most definitely in there. One would be, in fact, this is what I was just talking about right here, number 2. Okay, so these would be your marketable securities. So that was the example that I just gave you. Okay. Also, what would be in there is foreign currency. Okay, so you've got multinational company, they do business overseas, therefore they own currency, they own foreign currency. The value of those currencies change. Okay. So same conversation, as the value goes up or down, then the asset will be adjusted when it occurs, but it's not going to be on the income statement until it's realized. Okay, so in the meantime, it'll be in other comprehensive income. Okay, pension and retirement benefits are going to be on there, and also gains or losses on certain types of derivative instruments, and those types of derivative instruments, for those of you who know a little bit about this, is going to be on the hedging. Going to be on the hedging. Okay, actually, I take that back. It'd be on the speculative. I take that back. Okay, all right. So, and the reason they picked these is because these are of the most interest to investors. All right, so the other comprehensive income is going to include this. Now here's the thing, final exam review. What's the purpose of the financial statements? Most properly reflect underlying economic reality. Okay, going back to my example, if marketable securities went up $50,000, okay, did that really change the value of the company? I say yes. Even though they still own it, if they wanted to, they could sell it and realize that money and lock it in. Okay? So I argue all day long that it really does change the value of the company. Now we have an issue of reliability. Okay, so we got to get into fair market value measurement conversations, which actually we're not doing in this course, at least not to any great extent, okay? But we got to get into those kinds of conversations, all right? But assuming that the fair market value is reasonably accurate, then the company's value really did change. But again, it's not being recorded in income. It's not being recorded in income. So this other comprehensive income, in fact, the standards actually define it this way. So I don't have enough room here. Comprehensive income, the company's total income, will consist of net income plus this other comprehensive income. Okay, and the reason I'm harping about it is because, again, this is not included in earnings per share. Everybody watches earnings per share. This information isn't included in that. So you being the astute decision maker that you're becoming, when everybody else is all excited because McDonald's beat, go take a look at the OCI account. And I don't know what's in there. I haven't looked at it. Okay, but go take a look at the OCI account. If it's actually decreased, then you might want to not get so excited about it. Yeah.
So the OCI will be labeled in a separate area from the account?
Yeah. In fact, Walmart, well, when you get home and look at it a little more closely, you'll see it. But this is actually Walmart's statement of comprehensive income. Okay? So notice that what they have here is consolidated net income. So this is the net income off of their income statement. This is the net income that's used to calculate earnings per share. Okay, this is their real life statement. They have all the adjustments to it. I'm standing right here. I can't even read it. Non-controlling interests we're going to talk to about in a minute. Currency translation, derivatives, pension, okay, all the things that we just talked about, so forth and so on. And that gets them down to their comprehensive income. Noticing that when you get home and can actually read this, okay, There's a huge difference between the net income reported for earnings per share and comprehensive income. Specifically, the comprehensive income here is 40% less than their net income. Next one is 27% less, and from 3 years ago, it's actually pretty close. Okay, that's a huge difference. Okay? So I argue that that is very important information for decision makers, and I'm trying to launch a research project where I look into some of these things a little more closely, but I'm too busy dealing with Connect grades in your class to get around to it, but I'm trying. I'll get there. Okay, all right, so that's the upshot of other comprehensive income. Questions about that? Questions? Okay. Treasury stock. Okay, we talked about this a minute ago. This is them repurchasing their own shares. The primary reason they would do this is to, let me put that another way. The most common reason is probably to raise the share price. Okay, that's probably the most common. Because if you think about it, them repurchasing their own shares, they're doing that on the open market. So that's increasing demand, because they're doing it themselves. At the same time, it's decreasing supply, because they're taking shares off the market. So they're working both sides of supply and demand, which would increase price. Another reason they might do it is to change the ownership. Maybe they want to take back control of the corporation, so they start taking shares off the market. In fact, there was a big company, and not too long ago, I think we talked about this before because I couldn't remember the name back then, but it was a well-known company, and they just went private. They were public, and they bought back all their shares and went private again. And it's a name you would know if I could think of it. I want to say like Circuit City or something like that. It wasn't Circuit City, but you would know the name if I could think of it. But they just Oracle, was it? I don't know, something like that. Was it? Did Dell go private? He said Dell went private. Okay, I got two people saying Dell went private, so it's probably Dell that I'm thinking of. Yeah. They just did this, and the reason they did it is because they got tired of dealing with the SEC. Okay, so they take control back, and I'm joking a little bit, but they just went through all this. Okay, all right. So that's treasury stock. So of course this would be the entry. You already know that because we've been through that already. Just an example of the equity account. The last part of Chapter 8 is actually on a very complicated topic. I spent about an hour talking over the summer discussing this with Zhao. She just earned her accounting degree, as did Kelsey, and they go through great headaches with this. So she was a little more up on the current rules of doing all this than I was. So I was talking with her. We spent about an hour going round and round on this stuff. Very complicated area, but what you will see on financial statements, and I have an example. This is a Walmart over here. Is so here's their balance sheet, for example, and they don't have anything under assets. It might be buried under other assets. But if you look under the liabilities section, what they have on there is a liability, redeemable, non-controlling interest. And if you look down in the equity section, they have all the usual suspects down here. And all of this means something to you now. And they also have another one for non-redeemable, non-controlling interest. Okay, and what this is getting at is as follows. And again, it's actually a very complicated area, but I want you to at least understand what's going on. Okay, and what's going on as follows. It's a company owns stock in another company. So let's say your company. Okay, you've got a company. You're running a company. You own stock in another company. Okay, the issue here is your percentage of ownership. That's the issue. So if you own a very small percentage, okay, your company owns 500 shares of Apple, okay, well, you certainly don't come anywhere close to owning a significant portion of Apple. So that would just be on your financial statements as, as marketable securities. Like we've been dealing with, no problem. All right, so it's an investment. So far, so good? Okay. At the other extreme, okay, and Apple's not a good example, but at the other extreme, let's say that you own 100% of another company. Okay. If your company owns 100% of another company, then you control that company, obviously, right? Therefore, there are not two separate companies, there is just one company. So what you're required to do is to blend all of your financial statements together. That's why you see the name consolidated financial statements, because all of the individual financial statements are all consolidated together. Yeah.
So, for example, like, let's say we buy a company and we obtain all of their goodwill, but when we own that company, will we report the new company that we own on our financial statements?
It depends on the ownership, and that's what I'm getting at. When you buy a company, it depends on how much ownership as to how it's reported. Okay, and that's the point of this. So if you just own a little bit, a couple of shares, marketable securities, investment, no problem. At the other extreme, if you own all of it, then it's the same company because you control both of them. So for financial reporting, you put all of that together. Okay, the issue comes between those extremes. That's the issue. And I forget exactly where the cutoffs are, and I'm not going to test you. That's beyond the scope of this course. But I think it's between, I want to say between 20 and 50 when this comes in. Don't quote me on that. But somewhere in there, you own a significant influence in the company, but you don't control it. Okay? What you're required to do, the portion of the company, like let's say it's 30%. Basically, what you're doing is you're taking 30% of their financial statements and putting them on your financial statements. Okay, that's the gist of it. So I hope, final exam review, and I struggle to. Actually, I'll just do it this way. Okay. Hopefully, you know by now that assets equal liabilities plus equity. If you don't know that, start studying for the final right now. Okay? But assets equal liabilities plus equity. So this is your financial statements. So look at it this way. This other company that you own a significant portion of it, but you don't control it. And actually, it might be 80%. I don't remember. What you have to do is you've got to put those on there as well. So you'll report some of their assets, minority interest. Okay, so it's called non-controlling interest or called minority interest. Okay, so minority interest in the assets, minority interest in the liabilities, and minority interest in the equity. And that's what I just showed you on Walmart a minute ago. They didn't have assets listed on there. Maybe it was buried under other assets or something, I don't know. But they didn't have assets on there. But I just showed you that, they have their liabilities on there, and then they had the non-controlling interest liabilities on there. That was the liabilities from the other company. Okay? And same thing with equity. This represents their equity investment in the other company. Okay? So, like I say, so that's the upshot of what's going on. Exactly how they calculate the numbers for that, I think, do I have that on another slide here? Yeah, here's an example here. So on this fictitious example, this 262, how they calculate that number is complicated, right? And we're not going to get into that. I'd have to go, that's what I was talking with Zhao with over the summer. Okay, it gets very complicated because it depends, first of all, it depends on the level of ownership, and secondly, there are different methods for doing it. Okay, so we're not going to get into all that. But you as decision makers, what I want you to understand is what it represents. And what it represents simply is ownership in another business, significant ownership. Significant ownership, not just a couple hundred shares. Okay? Questions about that? Let me make sure, because this was so again, this was the Walmart, so there's your liability, and there's the equity. And again, how you come up with those numbers right there is Kelsey's problem. Okay? That's it for Chapter 8. Questions? Yeah?
In this case, would they only be liable for the initial cost of the investment if it's in stock?
What would they be liable for?
Wouldn't they be limited liability? Since they're purchasing stock, they're only liable for what they invested in the company?
Yeah. They're limited liability. So,
100% of the company's stock?
well, the shareholders, yeah, but the company is still, the shareholders have limited liability, but the company is still liable for their liabilities.
So if another company has stock, as you're saying,
Oh, I see what you're saying. I see what you're saying. I see what you're saying. You know, that's actually a good question. Let me stew on that. 'Cause he's asking if they own a significant portion, would they not have limited liability like any other shareholder? Let me think about that. I'll give you credit for that one. That was a good question. So, other questions? Other questions? Yeah.
Just to clarify, so redeemable non-controlling interest is relating to liabilities in another company, and then non-redeemable is equity?
Well, I would look at it this way, because like I say, when you start getting into redeemable, non-redeemable, it gets very, that's a heavy, they spend a lot of time studying that, and they spend a lot of time wrestling with that in the real world. I would look at it a little more simply than for our purposes, a little more simply, and that is that if your company, I should have put this in different color, but if your company doesn't own a significant interest in another company, then you're just going to have your assets, your liabilities, your equity, okay? You. Right? But if you buy a significant interest in another company, then you're going to be required to report your interest in their assets, your interest in their liabilities, and your interest in their equity. And really, probably the most important part of this is the equity investment in that company. Okay? So that would be for our purposes, that would probably be the clearer way to look at it. If you're really interested in the details of this, I'll put that one over on Kelsey. Get with Kelsey. She got her accounting degree too. She knows everything there is to know about controlling interest. Other questions? Other questions? Okay, it's a little bit early, but you guys in the mood for an early day? I am too, because it's my birthday. So we're going to take off the rest of the day. So, all right, good class today. Thank you so much. Good class today. I will see you guys on Tuesday. I will have homework posted or ready to go either this afternoon, tomorrow at the latest. Okay? All right, good class. See you guys on Tuesday.